Asset allocation is extremely tricky when you've got a handful of stocks that have been driving the train and you've got 6% alternatives in very short-term risk-free cash. It's really, to me at least, it's a no-brainer in terms of the choice to be made. So there are going to be pockets of strength here and there, places that are going to be recession-proof.
During economic downturns or volatile market periods, precious metals can act as a haven due to their intrinsic value and universal acceptance as forms of wealth. Unlike fiat currencies, gold and silver cannot be devalued by actions like excessive monetary printing, providing a sense of security that attracts investors during uncertain times. Danielle DiMartino Booth, CEO of QI Research, believes asset allocation can be highly challenging in the current market. According to Danielle, having a handful of stocks that have been performing well, but also having a significant portion allocated to alternatives and short-term risk-free cash. She emphasizes the importance of being cautious about credit exposure since the market is in the midst of a bankruptcy cycle and a default rate cycle. In this environment, safety and getting paid for protection become more attractive, making asset allocation easier than some might think. Danielle believes that the US dollar is a good choice for investments, but it might not remain a good option for a long time. Gold prices edged lower on Tuesday, the 1st of August, as the US dollar firmed, while investors looked forward to critical economic data this week for signs of how long the interest rates could keep rising to quell sticky inflation. The US dollar strengthened after a Federal Reserve survey showed that US banks reported tighter credit standards and weaker loan demand from businesses and consumers during the second quarter, evidence that the central bank's rate hike campaign is slowing the nation's financial gears as intended. Danielle advises that it's essential to be careful where to put your money. Germany's economy has been bad for a while, and Europe and China are also having problems. The U.S. economy is slowing down, except for the rich, who benefit from the stock market. This makes everything uncertain and unstable. We will now bring you clips from Danielle DiMartino Booth's interview with David Lin. But before we do, if you want more videos like this, ensure you smash the subscribe button and turn on the notifications bell for more videos. Thank you, and enjoy the video.
In this kind of an environment, I think you have to be up in credit, way up in credit. And because, again, you're in the middle of a bankruptcy cycle. You're in the middle of a default rate cycle. And you have to be cognizant of that. And if you're getting paid to be safe, and if your gold price is hanging in there, I think that it's just a lot easier to allocate your assets in this environment than people make it out to be. Maybe not if you're a mutual fund manager and you get penalized if you're not 150% in the stock market. I understand that. But if you're just Joe Q right now, you get paid a lot to sit on the sideline. I still see the US dollar as being, the most attractive horse in the glue factory. At some point, it's going to be no more. But for here and now, if you look at what happened as a factor of time with Germany's first quarter GDP announcement that was originally reported as being unchanged, subsequent revisions ended up pushing that into the negative. I suspect that the second quarter, there's a reason for this answer. I suspect that the second quarter German GDP print that also just came out as being unchanged, given sentiment indicators continuing to deteriorate, we're going to see a third consecutive quarter of a negative print once these revisions come out. The ECB is going to have a very difficult time if the juggernaut, the third largest exporting nation in the world, Germany, is in recession for 3 quarters running, and France just printed negative year-over-year unexpectedly retail sales. So Christine Lagarde's going to have her hands full in terms of her own higher for longer campaign, given that it's very much more obvious that Europe is sliding into recession, on top of the fact that Chinese official data are signaling that the services sector is on the cusp of contracting. And if that's the official data, God help us, who knows what the unofficial data really means. So you're talking about Germany and China at a time when the United States is slowing appreciably outside of the highest income earners that are also being propped up by a wealth effect because the stock market is high. At some point, you're running out of pillars of support here.
So you're saying short term, we can still see dollar strength. Is that what you're saying?
Medium term, we can still see dollar strength.
Medium term.
With every reason, just because we're in a disinflationary environment, And in many areas, we are already starting to see deflation, i.e. used cars. That doesn't mean that everything that was that suffered rising prices is not nowhere near pre-COVID levels.
Moving forward, Danielle highlights that smaller community banks face a significant risk of failing, especially when faced with recessionary pressures. These pressures may lead to a chain reaction of bank failures, causing potential ripple effects on the broader economy. While some argue that the failures of individual smaller banks may seem minor compared to larger institutions, Danielle points out that the combined impact of multiple more minor bank failures could be more substantial than anticipated. When a bank collapses, it can erode investor trust and cause instability in the financial markets. This may cause investors to flee for safety, putting their money in safe haven assets like gold and silver. This is because these precious metals will still have value even if the banking system faces collapse. Let's get back to the interview.
I think markets are definitely prepared for these smaller community banks to fail as we press forward, just with the usual recessionary impulses that would tend to take banks down. And of course, as you said, $130 million is a rounding error compared to what we saw last week with the forced merger of PacWest and Bank of San Francisco. So that's a whole different level of bank failure that we saw last week. And I think it's much more pertinent to discuss the market shrugging that one off, even though, after First Republic, it was PacWest that was lined up to be the next domino that fell. Hats off to regulators for making it appear as if PacWest was the acquiring entity. Some very clever accounting and PR done there. But I think that what we should maintain our focus on, especially as regulators are trying to destigmatize the discount window and re-stress how important it is that banks extend and pretend on commercial real estate loans. And this is coming from regulators from all angles, that there are more banking situations out that are lurking out there that we should be cognizant of. But again, David, nothing matters to these markets. So we're definitely seeing, the outgrowth of the ongoing credit crunch. It's just not one bank failing after another, and the risk of contagion that's making us paranoid. But that doesn't mean that there's not a steady drumbeat of insolvencies going on in the background. Interest service costs are going to be highly problematic going forward. And we just had the Treasury announce that it was going to be increasing its quarterly funding from $96 billion to $104 billion, longer out maturities. Things are going to get very difficult in Washington. And David, I think you need to look further out on the time horizon, because the more the government is allocating to servicing the cost of the nation's debts, the less it's going to have leeway in real recession to pushing forward with fiscal spending programs. If so much more of what is being spent just to service the debt. And we have to look out over that horizon, given the way that fiscal spending was structured after the pandemic.
As global economic conditions fluctuate and inflation concerns persist, investors may increasingly turn to these precious metals to protect their wealth and diversify their portfolios. This growing demand is likely to drive up the prices of gold and silver. Unlike fiat currencies, gold and silver are not easily influenced by monetary policies, making them a more stable store of value. How do you see the role of precious metals in protecting your wealth during economic downturns or uncertain market conditions? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.